Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing StarBulk stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. StarBulk Carriers is a shipping company focused on the transportation of dry bulk cargo. It owns 128 vessels with an aggregate capacity of 14.1 million deadweight tons and an average age of 10 years. Their ships transport iron ore, minerals, grain, bauxite, fertilizer, steel products, and much more. The company is headquartered in Marousi, Greece, and was founded in 2006. The ticker trades on the Nasdaq and Deutsche Börse. Let's get started with the model. This is a mid-cap company, 2.5 billion market cap. They're trading at $24 a share, and they have 100 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their numbers grow a lot from 2019 to the trailing 12 months. It was negative, now it's a positive 845 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative to a big positive. Revenue is the sales for the company, and that nearly doubles from 2019 to the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that grew from 100 million to 900 million. Below that is our operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, and that also grew more than 10x from 2019 to the trailing 12 months. They spent 46 million of interest on their debt, which is a lot lower than 2019 of 80 million. They spend 8 million of financing costs. Other income and expenses is all the gains or losses not part of the company's core operations. They have a negative 2.4 million in the trailing 12 months. Then your pre-tax income. They don't pay much in taxes. Earnings from equity interest is their earnings from investments in other companies. And the bottom line of the income statement is their net income, which looks really good in 2021 and the trailing 12 months. This is their income statement from their latest quarterly report, the first quarter of 2022 versus the first quarter of 2021. And revenue is up about 80% quarter over quarter. Net income is up about 400% quarter over quarter. The reason they're so much more profitable is because shipping rates are up so much. They were 15,000 in the first quarter of 2021. Now they're at 27,000 in the first quarter of 2022. They also increased their vessels from 119 to 128. But if shipping rates were low, say under 10,000 TCEs, then it doesn't matter how many ships you have, you're going to lose money. This is their statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. And that grew a lot from 88 million to over 900 million. They spent 71 million in CapEx in the trailing 12 months. These are investments in property, plant, and equipment. When they purchase a vessel, the cost of that vessel goes into CapEx. Operating cash flow minus CapEx gives you your free cash flow. And they pay a really nice dividend with their free cash flow. They've also been paying down debt. You can see in 2021 and 2020, they paid down more debt than they issued. Let's look at the capital structure. 2 billion of equity, 1.5 billion of debt. They're 57% equity, 43% debt. Their net debt is 1.1 billion. And their WACC ranges from 9.8% to 12% on Finbox. I used the highest WACC of 12%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 3 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.9 billion. We divide that by 100 million shares. And we get a calculated stock price of $28. They're trading at $24, so they're trading at a 15% discount. It's a buy according to the model. I did a video on this company a couple months ago in April. They were trading at 30. My price target was 29. And they've come down to 24. My price target is still around the same point. The stock was overvalued a couple months ago. Now they're undervalued because the stock price came down $6. Their revenue forecast for 2024 is $1 billion. For 2023, it's 1.1 billion, and for 2022, it's 1.2 billion. I continued this trend into 2025, and I got 968 million. That's how I got their future revenue estimates. They convert on average 29% of their revenue into free cash flow, so I multiplied their future revenue estimates by 29%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $71. They're saying it's 66.1% undervalued. 5 analysts priced this stock, and the average price target is 38, the low is 31, the high is 46. This is where the stock has been trading the last 5 years. Before 2021, it never broke through $15. Then in the past year and a half, it shot way up past $30 to about $35, $36. It has dropped a bit from that point, sitting at $24. So far in 2022, this stock is up 6%. Same thing with ticker BOAT, which is a shipping ETF. That's up about 6%. And the biggest shipping company, Zim, is down 18%. A lot of people have been talking about this stock due to the high dividend. Their yield is 27%, which is 80% of their free cash flow, 83% of their net income. From mid-2020 to the beginning of 2021, they cut their dividend to 0, but they started bringing in lots of money, and the dividend shot up to almost 35%. And the forecast is for the yield to be 20% by 2024. Shipping is a really cyclical industry. The price of a lot of shipping stocks got below $1, so the companies have to do reverse stock splits so they don't get delisted. They did a 1-for-5 reverse split in 2016 and a 1-for-15 in 2012. Their beta is 0.85, so the stock moves a little less than the market. It's gone up 13% in the past 52 weeks, while the S&P is down 12%. The 52-week low is 17, the high is 34. And the stock is trading below its 50-day and 200-day moving average. 3.5 million shares are traded each day on this stock. Of the 102 million shares outstanding, 67 million are on float, 56% are held by institutions, and 3.35% of the shares are shorted. If you invested $10,000 into this company 10 years ago, you'd have $6,400 today. That's a 36% loss. 54% of the companies held by institutions, 37% by the general public, 6% by insiders, and 3.5% by private companies. It seems like their employee count goes up little by little each year. They currently have 181 employees. Their biggest shareholders, Brookfield Asset Management at 25%, then the CEO at 3.5%, another insider at 2.12%, and a bunch of other companies. Let's look at their financial ratios. They have a really good PE of 3.0, that's stock price over earnings per share, price to sales of 1.6, price to book of 1.2, and a price to free cash flow of 2.9, that's stock price over free cash flow per share. Their return on invested capital is 22%, interest coverage ratio of 19, ROE of 39%, and they have a high current ratio of 2.1, a quick ratio of 1.9. They do seem to be well capitalized. They generated $845 million of free cash flow in the trailing 12 months. They have $352 million of working capital, and they paid out $678 million of dividend payments. The best way to look at ratios to compare them to companies in the same industry. There are 34 companies in the same industry as StarBulk, and if StarBulk has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend less than average in CapEx. They have a better debt to equity ratio than average. They pay a massive dividend, a lot higher than average. They generate more free cash flow than the average company. They rank 4th in market cap at $2.5 billion, average is $851 million. Their price to book is pretty close to average. They have an amazing PE and price to free cash flow. Price to sales a little worse than average. They generate more revenue than the average company. And they have a low ROA but a high ROE. So to summarize, I have them trading at a 15% discount, but the success of this company is really dependent on shipping rates. If rates stay at these levels, shipping companies are going to continue making lots of money and paying big dividends. And there seems to be a good chance of shipping rates staying high because the market is a bit volatile. Lots of things going on like high inflation, the war. So as long as there's all these disruptions, rates should stay high. I rank their free cash flows, revenue, and ratios 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.